Welcome. This is Thank God It's Friday. Well, the Indian benchmark indices have hit new lifetime highs, but the question is, are they running ahead of themselves? Let's find out. We're in conversation with Arvind Sanger of Geosphere Capital to take us through the various challenges the markets face currently. Arvind, thank you for joining us. Before we go and address the Indian markets, I'd like your view on the global macros currently. Are you seeing any signs of risk off, and what does it mean for emerging markets?
Well, no, I think on the global front, things seem to be fine. I mean, European growth seems to be continuing to be stronger than what many had feared, just as recently as, a few months ago, a couple of quarters ago. So that's good. U.S. earnings growth this last quarter was also a pleasant surprise after 7 or 8 quarters of tepid or non-existent earnings growth. We had earnings growth back on track for U.S. companies. So I think that growth on a global basis is looking better, and India is also seeing signs of that. So on a global basis, the risk is very much on, and as we've seen from the U.S. interest rate cycle, despite the Fed talking about raising interest rates, being on a continuous rate rise cycle, what we've seen is U.S. yields fall sharply, suggesting that the market does not think that U.S. interest rates are going to rise by quite as much as the Fed is suggesting. So I think the market's quite sanguine about the U.S. Fed, which is the only major central bank that is doing any tightening, and that's not causing any great stress in the system.
Arvind, how are you viewing the development in the crude oil prices, your expectations, and how do you think these dynamics will play out for India?
Well, I mean, I think India has been a huge beneficiary of, frankly, just one major factor, which is a shale revolution. And one of the things that is most astounding to us is that with about half the rigs working drilling for oil in the U.S. shale today, as we're drilling for U.S. shale oil in 2014, over the next 12 months, the expectation is that U.S. will add, almost 80 to 90% of the production that it added in 2014. So there's been a huge improvement in productivity because of finding some new plays in the Permian, and we're finding existing wells much more productive. And that's what's keeping a lid on oil prices, despite OPEC cutting. U.S. production growth, as well as maybe Libya and Nigeria coming back faster than expected, more than expected, have put a lid on oil price upside. But the bigger concern in the market is that 2018, the oil market could be oversupplied if OPEC wants to come back, and global demand growth is 1.4 million barrels a day. And if the U.S. is growing at over 1 million barrels a day, there won't be enough room for OPEC and non-OPEC to bring their barrels back to the market. So I think that oil prices are going lower to force U.S. shale to curtail some of its growth. And I think India is obviously a big winner of that kind of a backdrop, because oil is one of the biggest important drivers and one of the biggest current account deficit drivers, as well as one of the important factors in domestic inflation. And for all those reasons, I think it gives a lot more room for RBI to cut rates, and it allows for help on current account and for businesses in terms of costs. So I think it's a win-win all around for it.
Arvind, the fund flows in Indian debt markets remain robust. However, when it comes to equity markets, fund flows have been tapering to a certain extent. And now we have the case of China A shares being included in the MSCI indices. Is this a concern? How are you viewing emerging markets and in India specifically with respect to fund flows?
Well, I mean, I think if you're looking at global fund flows, India is clearly well ahead of other markets in terms of valuation. So people are always looking for, value buying, but I think India still remains one of the favorite destinations because on a growth trajectory basis, there's a much more visibility of growth. On a political stability basis, there's much more, confidence in political stability. So for all those reasons, India still remains amongst the most favored destinations, but that doesn't mean that, when Brazil was hugely oversold, after the whole concerns about impeachment of the previous president, then you had a lot of funds flow come into Brazil, and that was one of the best performing markets last year. So you have, other markets that see funds inflows this year. Mexico, which had suffered last year under the rhetoric coming out of President Trump or President-elect Trump, as that has not translated into anything much. Mexico has seen funds flow. So you will always see other emerging markets that have lagged see funds flows, and you mentioned the MSCI news on China A-share, and that will obviously drive some funds flows there. But I think the real India story is not whether there's going to be a huge upsurge in FII flows, but the domestic liquidity that continues to, increasingly treat equities as a favored asset class as compared to, other asset classes like real estate or gold, and that's, I think, a cycle that could last for a while.
Arvind, would you rather stay away from making incremental investments in India right now and wait for the entire GST-led disruption to play out, especially given that there's a belief that at least it could impact earnings for a quarter or two?
Well, yeah, I think clearly valuations are not cheap. Therefore, there's no compulsion to go out and buy right now. And you're absolutely right. One of the things that is, somewhat disappointing, but maybe it'll always be the case then when you have such a major, project being implemented, that there'll be a lot of teething problems. But we're expecting, businesses don't seem ready. The tax, system, GST is unfortunately much more complicated than any other major economy that has introduced a GST, and that may reflect the compromise between the state and the center, or states and the center. But whatever the reasons, it is going to cause disruption and a lot of confusion and some dislocations. We don't think the dislocations will be tremendous, but for one quarter, certainly, there will be some minor dislocations and some earnings unpredictability. So that could create opportunity. If it does, we would welcome that. We're not saying this is it. We're definitely going to get a big chance, and therefore let's wait on everything for that. But we're waiting for. You never know what causes markets to pull back when they get extended on a valuation, something or the other comes along.
Arvind, we know that you have interest in Indian crop protection and chemical industry. What we'd like to know, and we have been talking to a lot of mutual fund managers as well. They're also very well invested in these sectors. The question is, considering the valuations at which these stocks are trading at, would you advise investors to move in? Do you still see a substantial upside from an investment point of view, or would you rather have them wait for a bit to correct and then enter into some of these stocks?
Well, yeah, I think at this point it's hard to pound the table and say that most of the stocks that we've looked at, like crop protection or chemicals related to agrochem or what have you, that they're undiscovered stories of valuations are cheap. So we would say that in almost every sector, including NBFCs, which has been another area that we've liked, we would say that putting a lot of money to work at these valuations is probably risky unless you have a very long-term horizon. But for the short to medium term, we think there could be some opportunities to buy at more attractive valuations.
Arvind, of course, the biggest challenge in today's market is to find value. Do you still believe there are any undiscovered themes or themes which you would still like to bet on even at current levels in India?
No, I wouldn't say there are individual themes that we can bet on at this stage in India. There are always individual stocks that one can buy, but even themes like one of the themes that we've liked recently, which is the domestic hotel industry. Valuations have moved up, but that's a cyclical industry that has gone through several years of very little demand growth and almost no pricing. And we've started to see in the last year both demand and pricing start to move. GST does create some confusion, and some of the higher end hotel rooms would see a rise in GST related taxes. But we think that areas like that again. Maybe GST creates opportunities, but I would say that undiscovered themes are hard to find, but individual stocks where valuations may get attractive for whatever reason is probably easier to find. I mean, if you were to take the undiscovered or the cheap theme stocks, then it would be pharma and IT. And while we don't do much in pharma, I would say pharma probably has a better outlook because I don't think the U.S. government is going to be quite as draconian on pharma prices as people are concerned about. Whereas on IT, whether it is the H-1B visa issue or it is the technology challenges in terms of automation, those challenges I don't think are short-term in duration.
All right, Arvind, thank you so much for sharing your thoughts with us. That brings us to an end of this edition of Thank God It's Friday. But do continue to watch Bloomberg Quint for more updates on markets. Have a good weekend.